I bet your number one struggle is knowing when and what to sell. And guess what? You're not alone in this.
Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Veronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host today, and we're getting a bit in advance today because we're doing spring cleaning before the official date that spring is coming up. How are you doing, Veronique?
I'm doing good, Mike. And for once, I'm going to be with you on that. I can't wait for spring. Like, I'm done with winter now. Mike, knowing when to sell is the number one struggle among investors. And we know that because we've worked with investors for over a decade. And today we offer you 5 selling rules for spring so that you don't get stuck in the same paralysis.
Yeah, selling is so hard. I mean, on one side, you don't want to be wrong. On the other, we often hear, well, I don't lose money if I don't sell. And unfortunately, I'm here to break that up because that's not true. The opportunity cost when you hold your shares of Nortel for like 20 years, I mean, you're just blinding yourself, but eventually you're going to die and those sales are going to be sold and there will be a loss anyway. So you're just postponing like the inevitable. And this is why it is important to act now.
And before we start, I must invite you to tomorrow's free webinar on how to clean your portfolio. The webinar will expand on the discussion of today and provide more tips on identifying stocks to sell. So join us tomorrow, Thursday, March 20th at 1 p.m. Eastern Time at thedividendguyblog.com/webinar.
And if you're late to listen to this episode and you're past March 20th or you cannot make it for the live session, still go on the same link and you will watch the free replay.
Okay, Mike, so let's dive into this. The first rule is to determine the number of holdings in your portfolio. You believe the sweet spot is between 20 and 40, right?
Yeah, so before we start even talking about selling stocks, you must have some ground rules. You must know where you're going. And of course, since we are just focused on investing in stocks, we're not going to talk about like ETF mutual funds or anything else, but rather the stock portion of your portfolio. I do believe that the sweet spot after several years of investing is between that 20 and 40 holdings. Make it easy on one side to manage, but having a good diversification at the same time.
But what's the danger of having less or more than that?
Well, I mean, of course, some investors, they have like a top 10 or even top 5 stocks and they're super happy with that. But what I don't like about this strategy is it leaves little room for making mistakes. I mean, if you have 10 stocks and you're wrong on 2 of those, well, that's likely 20%, maybe 25% of your portfolio at risk. So it's hard to have a good diversification and you better be right every single time you make a move. And I don't know, like after 21 years investing, I realized that I make mistakes from time to time, so I would like to spread my bets across a little bit more than 10 stocks. On the other side, yes, it's great to have like 50 or 75 or 100 companies. It gives a sense of, oh, well, even if a company crash and burns, I'm not going to feel it. That's true. But if the company doubles in value, you're also not going to feel it either. Not too long ago, I had that discussion with a client and she said, yeah, my portfolio is down like 1% today. And I'm like, imagine that. If you have like a 0.32% position and it doubles, you're not even going to feel it on your portfolio while your entire portfolio can go down or up by 1% in a single day. That is the first thing that I don't really like about this strategy. And the other thing is the more stocks you add to your portfolio, the more chances you are just adding the more of the same. The odds of adding like 5 banks, 3 insurance companies, and then 15 pipelines are greater if you have 100 stocks in your portfolio versus limiting yourself to like 30 to 40 companies. Finally, as you build up your portfolio and you have more and more and more positions, chances are you're not going to only add companies that are fully aligned with your strategy. So you're going to
Right.
have a little bit of growth, a little bit of stability, a little bit of like, I don't know, falling knives, and then a little bit of like super high growth, high ping, trendy stocks. And in the end, you don't have a strategy. You're just like putting everything that you read about or you watch about, and then you just put that in your portfolio and you hope that the mix is going to work out. Well, I like to think that when I build my portfolio and I manage it, I like to see it like a hockey team, for example. It's not true that if tomorrow morning I would open a expansion team and I would just sign up all the free agents, that would not make sense. Maybe I would end up with like, I don't know, like 12 right wingers and no centers in my portfolio. Like it doesn't make any sense. I have to have a strategy, have like some players that are more geared towards offense, some about defense, but I need to create this coherent group instead of just like piling up signatures with good names on it.
And once that number is settled, it gives you a target position. So, what is a target position and why is it useful?
Yeah, so the idea of having this ground rule, and to be honest, the point here between 20 to 40, even if you're at like 50 and you don't want to listen to me, that's fine. The point is to have a guideline here. Because if you have a guideline and you want to have like 50 position in your portfolio, well, the target position should be around 2%. Of course, some stocks will perform better than others, and eventually you're not going to have like 50 companies at 2% each. I get that. But at least you have a guideline. So when it's time to sell stocks or to buy more, you know almost how much you have to invest in those companies. So it's a reference point, not necessarily a life and death rule, but I
Mhm.
like to use it. Like for myself, I like to have like a portfolio between 30 to 35 stocks. So my ideal position is about 3%. So whenever I look at a stock and I want to buy one more, well, I'm trying to get 3% of my portfolio on this new play. If I'm not able to do it, I will say that I'm initiating a position and I'm trying to derive all the dividends I'm getting if I'm selling any other shares later on towards that position until I get the full target. So it's more to have like a goal here and make your decision easier instead of saying, "Oh, should I put 5,000 or 10,000?" Well, you just put 3% of your portfolio every single time you buy a position. So you don't have to wonder for like 5 days how much you should invest.
All right, so now if you go over that number that you've set yourself, you must sell. But where to start? Which stock to let go of? This leads us to the second rule, which is to get rid of insignificant positions. So please explain it to us.
Yeah, so I already talked a little bit about it, but the fact that you have like companies at like 0.32, 0.28, 0.50% of your portfolio, they have zero impact on your portfolio. They could double, they could lose 80% of their value. You're not even going to notice. So in the end, it just creates noise. You have like maybe 50, 75 lines in your brokerage account when you open it, and some of those lines, they don't have any impact. So what's the point? On the one side, they're probably too small for you to care. So you don't even monitor those companies. And you're just kind of like, what? You hope for the best for them. I mean, hoping is not an investing strategy, right? So you should know what you own and why you own it. And I'm not willing to spend like 3, 4 hours to do due diligence on a stock that I've invested like 500 bucks on it. That's definitely not worth my time anyway. And I realized that as well not too long ago, where I sold CAE and Disney around 22, I think. And I was debating back then for like a good 2 years between 2020 and 2022 if I should keep those stocks or not. But they were about 2% of my portfolio each. So in the end, I debated for so long for such a small position that regardless if I sell or if I keep, it's not going to really have an impact. But imagine we were talking about like about 2% of my portfolio. Imagine if it was 0.32. Like that would
Mhm.
be just a waste of time, a waste of energy, and most importantly, just another line create that confusion leading to more paralysis by analysis.
All right, but Mike, let's pretend I have like five stocks under 2%. So, how do you make the difference between a 2% stock worth keeping and adding to and one to sell? Like, which questions should investors ask themselves?
The point here is to keep it very simple and to driving your decision into a binary choice, yes or no. So the first thing that you should take a look at is to understand, like, okay, so is this company's aligned with my strategy? In other words, what's the investment thesis that I have for this company? Why I like it so much? And is it still relevant with the portfolio I want to build? So if I want to focus on dividend growth investing, and then I have a company that has been like 5 years, it doesn't increase its dividend. Well, I'm kind of late to the party to sell it because it's
Mm.
definitely not aligned. So asking yourself why you buy those companies is a really key differentiator. Then, once you have like a good reason, that's great. So you have a good story. You need to verify if the numbers make sense. Because it's one thing to tell yourself that a company is amazing, it's another to look at the revenues, the earnings, and the dividends. So if everything's going down, well, your investment thesis is just not right. So that's also another sign that this company maybe underperformed for a while and went onto that 2 or 3% bar that you set. And the ultimate question, once you have done that due diligence, is to ask yourself, do I like this company enough to buy more of it right now and bring back the position to roughly 3% of my portfolio? If you don't like it enough, well, that's a yes or no question. So you either put it to 3% of your portfolio or you just sell and use the proceeds to maybe invest in another one. Because, of course, among your 5 companies in this example that are very small weighted, some of them probably deserve more love. And then you will be able to do that by selling the stocks that should not be in your portfolio, get that cash in, and then use it to boost positions that actually should matter in your portfolio.
I hear Mike and it makes me think about my portfolio. And currently, like there's one stock that keeps coming up for me and it's TELUS because you just said, are you ready to put like to make it up to 3%? And I'm like, no, I'm not ready to buy more of TELUS right now. So like really, this is getting like on the sell side for me. So just like just a thought here.
Just pushing a little bit you. So I still need you to complete the show though before you open your brokerage account. Okay, so stay with me for a few more minutes because we're not done yet with the rules.
And by the way, listeners, if you'd like to like get this feeling and work on your portfolio, get the urgency to work on your portfolio, join us tomorrow for our webinar at thedividendguideblock.com/webinar. All right, so Mike, the third selling rule is to get rid of duplicates. To do so, you will only keep the best among them, right?
Yeah, I mean, stocks are not like Pokemons. You should not catch them all. That's not the point. And just buying more of the same company with the same business model is actually opening the door to a great exposure to a risk. Every time there is a market correction, it starts somewhere. So there's a crisis in the utilities industry or in the financial sector or in the technology bubble bursts, but there is an industry that is getting hurt big time. So if you're buying like 5 or 6 companies in the same industry, you're just opening the doors to get really smacked when this happens. And this is
Mhm.
why I think you should just keep the best and get rid of all the others that are just trying to mimic the best companies in an industry.
So, Mike, it could be easy to fall into seductive stories here. So, in doubt, you always let the numbers speak louder. Could you give us an example?
Yeah, so that's often the problem, right? So we are interested in investing in an industry. So let's say, okay, so I want to get exposure to artificial intelligence. So I'm going to buy semiconductors companies. That's great. I get the point. But then you look at the companies and you're thinking, well, I don't know which one will actually win the AI race. And I might as well diversify my bet and invest into like 4 or 5 companies in this industry, which to this point kind of makes sense. And it's hard to make that difference. But if you want to really just pick the best companies out of each industry in order to have like a better diversification, not getting smacked when the AI bubble will burst, well, then you can use numbers versus the investment thesis. Here's a good example. Would you invest all your money into Intel or into Broadcom if you're looking at those? Well, Intel is falling behind right now. The revenues and the earnings are dropping. They cut their dividend. They actually suspended their dividend, if I remember correctly. They are struggling right now. So, yes, it could
Mhm.
be super tempting to invest in Intel right now to see, oh, I'm going to catch it at the bottom and it's going to double and it's going to be an amazing story. Yes. I remember those days when I was golfing, thinking that I could actually cross the lake, cross the forest, and land on the green. And I hear you laughing. You know how it ends 99% of the time. So I have a good memory. So I only remember the one time that I made it, and I forget about the dozens of balls that I lost in the woods or in the lake. That's pretty much the same thing with your investment. But the thing
Mm.
is, it doesn't cost that much to lose golf balls. Investing 25K into Intel could hurt my portfolio big time. So instead, I look at the numbers and then I look at this thriving companies, Broadcom, that grows their revenues, grows their earnings, and grows its dividend every single year. So in doubt, I will pick the one that has been thriving over the past 5 years on top
Mhm.
of doing a due diligence to understand the business model and so on. Another good example would be Scotiabank versus National Bank. A lot of people will say, but Mike, it's impossible to know what's going to happen in the future. I mean, okay, so it's been 15 years that I'm telling investors that National Bank shows a better dividend triangle than Scotiabank year after year. Well, guess
Right.
what? Shocker. Over the past 10 years, National Bank outperformed Scotiabank. It's just as simple as this. If you look at the numbers, they will tell you the real story. Yes, you can make up a great investment thesis, but if you do not validate with numbers, it's going to be very tough. My favorite tool to quickly identify a winner, and I've done that in a newsletter not too long ago to show that to my Dividend Stocks Rock member, is to use the DSR comparison tool. So I actually pulled out all the semiconductors companies one by one. You just look at the dividend triangle. You have like all the numbers into one screen, and it's super obvious to pick the winners out of that. And then when you look at the stock price, you're just like, oh my God, those companies are actually thriving and they're generating like returns for shareholders, while the companies that shows their revenue and their earnings declining like every single year, they're not. They're losing money for shareholders. I mean, what a surprise, right? But that's the thing. If you keep it simple, you focus on numbers, you're going to easily determine which company has the strongest financial profile. And this is where I would put my money on. Maybe I'm going to be wrong, but
Mhm.
actually have a very solid rationality behind my decision, which is
Right.
going to help me invest with conviction and also take action. Because if you're just stay at the point where, well, nobody knows what's going to happen in 5 years. All right. I mean, pretty good statement. You're right. So what are you going to do? Nothing? You're going to stay
Mm.
paralyzed for 5 years? And then in 5 years, what are you going to do? Nothing again, because it's going to be the same rhetorical question of like, nobody knows what's going to happen in the next 5 years. So instead, try to have like set of numbers that are important for you. Like on my side, obviously, is the dividend triangle. It could be something else for you. It could be free cash flow. It could be the debt level. That doesn't really matter. You identify financial metrics that matters for you, and then you compare each of the companies in the same industry. The best one, the one that will outperform, will show stronger financial metrics.
And you know my love for the stock comparison tool at DSR. I think it's one of the most appreciated tools at DSR, that's for sure. Like we hear about the stock comparison tool from members almost daily, like weekly at least, that's for sure. I love it. I've used it time and time again. All right, so the following rule is to get rid of bad stocks. However, this seems challenging since we all once loved the stocks in our portfolio. So, how would you identify losers, Mike, like real losers? Do you automatically sell and move on? What do you do?
That's a big question because the tricky part is you don't want to be trigger happy and sell because you're quickly losing 10% on a stock
Mhm.
to just realize that a year or 2 years later, that company is thriving. On the other side, you don't want to hold on to those losers for the next 5 or 10 years and actually not invest anywhere else in the meantime while the market is
Right.
going up and your holdings are just destroying your retirement plan. So the line is really tough to draw. But what I do is I usually start by looking at my investment thesis and the financial metrics. So, same thing that I just did for the duplicate, I will apply that to companies that are showing double digit losses on my portfolio. I don't like to have like a simple rule of like, oh, if it's down 25%, I'm selling because I would have sold all my portfolio during COVID, or I would have sold like Microsoft and Apple during 2022, and that would have been a big catastrophe. So instead of having like that kind of rule, I rather say, well, okay, so this company's down double digit. Let's take a second look at it. Like, of course, it bugs me. It's a big red line in my brokerage account. So now it's time to remind myself of what are the reasons why I hold this company and what's the numbers are looking like. So here's a good example, Granite. I mean, we've talked about Granite for a few times here, but it's a very frustrating holdings right now because the company's doing well. The numbers are great. The investment
Mhm.
thesis is great, but the stock price is not going up. Like literally, I think I'm still down like 15 or 20% on that position if I exclude the dividend. If I include the dividend, I'm getting close to breaking even. But even then, in a market that goes up so high so fast, being break even being up 5% is definitely a loss of a good use of my capital. So as long as the numbers will be right, I will not give a second thought about Granite. And that's the thing. Even though it goes down, I don't care. I don't care because it fits, it's aligned with my strategy. It keeps on increasing distribution. The funds from operation keeps going up. And if the market doesn't like it right now, I'm good with that because I believe in the value of the business. And I believe it because I'm backed by financial metrics. If the financial metrics were going down, I would probably sell. Now here's comes the point where you have a business that either your investment thesis you realize that you're not that right about it, or the financial metrics are not going towards the right direction. So where do you draw the line? Are you patient enough to wait, and how long should you wait? Because keep in mind,
Mhm.
5 years is still short term. I started investing at the age of 21, I think, and I will likely invest until I'm what, like 80, 85, 90, maybe if I'm lucky. So that's like 60 or 70 years of investment. So 5 years out of like 60, that's nothing,
Mhm.
right? But
Right.
here's the thing, you don't want to like, oh, those losers for so long. So if I see a company in my portfolio with a weaker dividend triangle. And here's a good example, like for Alimentation Couche-Tard, starting last year in 24, bad quarters after bad quarters. So we have like revenue declining, earnings shaky a little bit. So besides the dividend growth, like nothing is really strong over the past like 5 quarter or so. So I determine a time frame, even though I love Kushtar and even though I have to plug it pretty much every single podcast that we do. Let's protect my portfolio against myself and against the love that I have for this business, right? So I have
Mhm.
to set up a time frame. I like to be patient, so most of the time I will wait 2 to 3 years. For Kushtar, definitely willing to wait 3 years. So 3 years starting from 24, that means that in 27, I will have to sell the stock if the dividend triangle is not back on track. During that time, what I will do is I will follow and I will monitor every quarterly earnings. I will look at metrics. I will look at what management does because, of course, they're not blind. They know that the business is not thriving as it used to.
Right.
So, my questions are what's the plan? Like, what are they going to try to make it better? And is it successful throughout like every quarters, right? A good example that we just saw not too long ago is Starbucks. So, Starbucks, they changed their CEO after having like a terrible year in 2024. They came up with a plan. The market is like it likes the plan. So now there is some momentum around the stocks a little bit more. But in the next coming quarters, we want to make sure that this plan is actually going to work. Because if management is saying, oh, we're going to narrow down our menu, improve our margin, and opening new stores, and then in 3 quarters from now, you look at the margins and they're actually declining, and their sales are declining because they're not offering enough item on their menu, well, the plan sound good. That sounds like a good idea, but didn't work out. And at
Mhm.
that time, well, combined with your time frame, you can see if the company is heading towards the right direction or not, and eventually get rid of it if they're not able to get back on track. Because as much as I want to invest for decades for each of my holdings, the economy changes, the business environment changes, the company itself will change, management team as well. So whatever Starbucks or Alimentation Couche-Tard was 15 years ago, not the same company today and will not be the same company in 10 years. So not necessarily mean that I should hold those companies for 25 years. Always have to take a quick look on what's under the hood.
And Mike, you've said that you're willing to wait between 2 to 3 years, but what if a big bad news happened during this time? Like, will you still stick to your holdings for a while or sell? Like, let's pretend a dividend cut or like the dividend triangle really slows down even more. Like, are you still waiting or do you sell sooner?
That's a very, very good question. Actually, this is the reason why I monitor those companies quarterly using DSR Pro. And on top of that, now we added a new feature that is amazing. I receive an email the moment that our analyst teams have reviewed the stock. So I cannot miss any news. I just get it in my mailbox. And then if a big thing happened like this, like let's say that Couche-Tard for the next 3 quarters, now their earnings and their revenues are going down double digit, and it's a real catastrophe. Well, then the time frame will not stand anymore. Keep in mind, I have not mentioned the stock price fluctuation once during that segment. My point is not, oh, Couche-Tard is down 30% from its peak value, I'm selling. I don't care about the 30%. What I do care about is if earnings and revenues are down every quarter by 30%, then we have a big problem. Clearly, management doesn't know what to do to get the company back on track. And then I will be forced to reduce that time frame and just sell it. And that
Mhm.
that will happen. If there's a dividend cut, I would sell right away. If
Mhm.
not, it really depends on the case, of course. But a business that is actually aggravating its situation, probably that I'm not going to hold the stock for 3 years. I mean, there's a limit to the patience. You still also have to have some rationality behind it.
Your portfolio should not be like your garage. I know this might sound weird, listeners, but you need to hear this. We have all opened our garage or shed in spring and been horrified by its mess. You may feel the same when you look at your portfolio, yet you shouldn't. This is why we are inviting you to our next webinar. On Thursday, March 20th at 1 p.m. Eastern Time, we will hold a free public webinar on 5 steps to clean your portfolio. Why should listeners not miss it, Mike?
First, I must say, I love this analogy. I mean, whenever I look at either my basement or my garage, I always feel the same, you know? And the thing is, on one side, you're thinking, well, it's messy. And on the other, you're just like, well, there's no emergency here. I should not even touch it. There's so many other great things to do, especially that we're coming into spring, such as like a nice walk outside and enjoy the sun. But
Mhm.
here's the thing, when you look at your portfolio and you think the same way, there is an emergency to act. You don't see it, but your portfolio may be burning right now and you just don't smell the smoke yet. And that is the problem. Maybe you're following too many stocks, or let's be honest, you don't follow any of them. If it happens, well, then you probably have a few companies here about to cut their dividend or to crash, and you don't even know about them. And you want to prepare your portfolio for what is coming up next. Since the beginning of the year, it has been let's say, a crazy year of uncertainties, and I'm pretty convinced that it's going to continue this way. So it's the best time to act now and clean your portfolio, get rid of that paralysis by analysis. And this is why I will share with you my 5 easy steps to follow to clean your portfolio. And yes, you will not be right 100% of the time when you sell, but you can do it with 100% confidence. And this is what we're going to work on in this webinar.
After the presentation, we will continue with a full hour live Q&A session. This is your chance to get Mike's thoughts on stocks, sectors, or other investing topics. Seats are limited, so save your spot now at thedividendguyblog.com/webinar. I'll be in the chat, so please let me know you're podcast listeners. Again, register for the live session or to get the instant replay at thedividendguyblog.com/webinar. See you on March 20th. All right, so the last selling rule is to let go of the good stocks. Some listeners might think this is an insane thing to do, so please, Mike, share your thoughts on this.
Yeah. So first things first, I like to let my winners run. So okay, I'm going to repeat it. Like I let my winners run. In my portfolio, I have holdings that I've been holding since 2010 when I started my dividend growth investing strategies. So the goal is to hold them for a very long time. And I hold a lot of companies showing triple digit total returns in my portfolio. I even have like Apple showing like 1,500% return because I owned it since 20 like 13 or 14, something like that. So yes, you want to let your winners run. But as I said earlier, companies change, environment changes, everything changes. So sometimes those companies are slowing down or new competitors arrive or consumers are just moving on to another product and that company becomes irrelevant. So for those reasons, it's important to know when is the right time to cash your profit. Not too long ago, I had to, despite my love for BlackRock, I had to say goodbye because the company offered a 2% dividend increase for 3 years in a row. So here's
Mhm.
again, same rule of before. Okay, first dividend increase of 2%. That's not aligned with my strategy. I want to have companies being able to increase their dividend by like 5 to 10% per year. Two is really low. 1 year can accept that. 2 years, all right, but now it's getting on the watch list. The third year in a row, definitely BlackRock, even though it's an amazing company, my investment thesis is still valid. Largest asset manager in the world, largest ETF manufacturer in the world. They make money regardless if the market goes up or the market goes down. They have like
Mhm.
strong bond with institutional investors. All of that remains true. But the company is not aligned with my strategy anymore. There you go. It's gone. It's a big winner. I made like 165% profit on that trade. So super happy to have it. But if it's not 100% aligned with what I want to do with my portfolio, what's the point? It's going to
Mhm.
hurt my conviction. And maybe later down the road, it's going to be a bad stock. So again, the key here is not to be right 100% of the time. I don't know what's going to happen with BlackRock, and maybe BlackRock is going to double in value in the next 5 years. Good for shareholders. The point is, it's not aligned with my strategy. It's out because as clear my strategy will be, as easy it will be to follow. And whenever the market goes down, I won't even have to care about what's going on in the world because I know that the companies I own are solid and they're exactly doing what they should be doing. So that's the
Mhm.
first rule. The second sub rule of this is when the winner is becoming too big. And that is really important as well. So if you have like a 10%, 15%, 20% exposure to one stock, well, imagine that if this stock goes down, it's going to hurt your portfolio big time. So you have to set a limit. Like on my side, I set a limit of 10%, but that's an arbitrary number. It's just to make my decision easier. Whenever a stock hits 10, I drop it by 1 or 2%. So for some people, it will be an 8% limit. Some others will be 15. Some others will be 4. Doesn't really matter. What matters is you have your number as a clear rule. And then whenever it goes above, you just trim. So you keep it easy. It's going to take you like 2 minutes to realize which one is overweight according to your standard. And you just manage your portfolio accordingly.
Already mentioned it, but I want to go back to that. It's important that you consider we did not talk about stock price as a selling rule. Why should it not be part of your selling rules, Mike?
Because the stock price on the short term is pure noise, like on one side or another. I mean, you're not a great investor if the stock that you just bought 2 months ago is up 25%. You're just lucky. And you're not a bad investor if it lost 25%. You're just unlucky. That's pretty much it. And when you have those rules, I mean, selling at a 50% profit would prevent you to generate 100, 200, 400% returns. And selling at a 25% loss, as a rule, as I said, I would have liquidated my entire portfolio several times over the past 10 years. So I don't think it would be a good thing either. So
Right.
instead, I always bring that back to yes, I get it sucks. Your investment is down 20 or 30%. Of course, you're asking yourself questions. Well, those questions should not be, oh, is the company can rebound or not? But rather, why do I have it in my portfolio? Is it still aligned with my strategy? And are the numbers backing up that story I tell myself? Is the
Mhm.
numbers are still good, you're good. Many, many times when a stock goes down and keeps on dropping, eventually the numbers are not going to be good either. So you're going to get closer to the rule where we sell the losers, but it's just going to be a red flag, not necessarily anything that you should like take action. And I've seen this so many time on earnings day, a stock price going down double digit. I can't even remember how many times I've seen that now. And I receive like tons of emails every single time, which is just pure noise. Imagine selling Broadcom in 2018 when they announced an acquisition and the stock price dropped by about 10%. Wow, that would have been such a mistake. So
Mhm.
never do that just on stock price. Have a more complete reason, more rational reason to sell or even to buy.
All right, so let's end with a quick wrap up of the 5 selling rules. Number 1, set a minimum and maximum number of holdings. Number 2, sell insignificant positions, those below 2 are the limit that you've set yourself. Don't make a difference in your portfolio. Only select the best stocks among your duplicates. Number 4, get rid of the bad stocks. And number 5, trim the good stocks or sell if they don't meet your investment strategy anymore. Mike, do you think these 5 rules cover all situations?
Well, probably 95% of the situation, if not all. But see, the point again is you will never be right 100% of the time. And this is what caused paralysis by analysis is you don't know. And I don't know either. But if you have simple rules to follow, you can quickly get rid of the stocks that should not belong in your portfolio and get rid of that hesitation. And that is a big plus going forward because the more mistakes you own and you drag in your portfolio for like decades, the less confident you will be when the market goes down by 15%. So
Mhm.
instead, just focus on your strategy, have clear rules, and once you follow them, you don't even have to think because they have been proven to help you invest with that more conviction.
Well, thanks a lot, Mike, for these useful yet still simple selling rules. Listeners, make sure to get a complete canvas for cleaning your portfolio by attending tomorrow's free webinar or get the free replay. Save your spot now at thedividendguyblog.com/webinar for the live session or to get the instant replay and also get a chance to ask your questions to Mike live during the Q&A. Again, hit thedividendguyblog.com/webinar now. For the show notes and related content, visit thedividendguyblog.com/219. Until next week, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.